Prepare yourself for an experience that has challenged many in the past. And this is the matter of accrued expenses. We were accounting for purchases and setting up liabilities on our balance sheet for invoices for bills received from suppliers that we hadn't yet paid. Accrued expenses has got a similar pattern to it. The difference really being that the amounts are generally somewhat less certain and haven't yet been invoiced. So accounting for accrued expenses. This is all our cash purchases stuff, so we're going to change a few things. So let's get rid of these labels. Let's get rid of these amounts. Just keep our framework. Now let us expand this. So we had payables before, bills, invoices. Let's say payables and accrued expenses. So accrued expenses are liabilities that we expect to settle in the future, but we don't have to settle them yet, and we haven't yet settled them, and indeed we might not know exactly how much they are. The other bit we need to change is increase in payables and accrued expenses, so we're just lumping them together. Reduction in payables and accrued expenses. Lumped together. Now we will have 4 transactions to have a look at. They're parallel the purchases from before. Expenses, things we're going to have to pay that are shorter term in nature. So let's just say it's repairs, to give a simple example, and not to, or I hope Madingley Hall is strong enough to withstand some fictional repairs, just since we've got this lovely building behind us, and I hope we're keen to keep it in good repair. Then, should it need a repair, then the first thing we might do is just pay for that repair immediately. So cash expenses. Let's just spell it out, not previously accrued for, or not previously recognized. Let's write all that out for completeness. Recognition is to do with putting something into the accounts. So cash expense is not previously accrued for, meaning not previously recognized. We spend some cash. Let's make the numbers different. So let's say it's 3 this time. So cash goes down by 3. We make a payment of 3. And this expense is recognized immediately. So it translates into a loss for the period. So in this period, we lost 3. We had an expense of 3. We settled it in cash immediately. So the item is in both in the cash flow and it's in the income statement. There's no difference between cash flow and income statement. No difference between the loss in the period of 3 and the cash outflow for the period of 3 because the item is in both places. Okay, so far. Now let's do something slightly different. Let's recognize accrued expense. So recognize an expense. Let's do that bit first. That means we're putting an expense into the balance sheet. And the income statement, let's say it's for 4. So we've got a further loss, unfortunately, in the period. Well, is it unfortunate? It is as it is. Better to recognize it, I guess, and better to recognize it than ignore it. Just put this underlines in. Let's correct this formula. So we're doing single periods here, weeks, months, quarters. So our cost is 4. We expect our net assets to have gone down. They will go down when we've accounted for them correctly. So we're recognizing a liability, and the liability is an accrued expense of 4. So we've got a new liability of 4. Has our cash moved? No, because we haven't paid it yet. So no payment or receipt. Have our net assets moved? They have. They've moved because we've got a new expense. It's reflected in this liability. We've got a loss of 4 accordingly, but no change in cash. And the reason is that accrued expenses increased. We've had the benefit of the repair, but we haven't had the bill yet. So we're recognizing this liability, but we haven't paid anything. And this pattern is exactly the same as if we had had the bill, but we haven't paid it yet. It's another example of a liability to be settled in a future accounting period. So another timing difference.